Hello and welcome to today's masterclass on building a solid financial plan. My name's Matt Conradi and I'm Deputy CEO and Head of Advisory here at Netwealth, and I'm joined today by one of our client advisors, Lily Ball. What I'm going to do is start by just sharing my screen, and then we're going to talk through some of the areas that we'll be thinking on today's session as we go through. But before we do that, I just wanted to highlight, if you do have any questions, it'd be great for you to send those in. There's a questions section you'll find on the screen in front of you. If you have any technical issues as you go through, please just start by refreshing your browser, which normally resolves those issues. If you'd like to get in touch with us as well in due course, you can see on this slide any questions, do send those through to advice@netwealth.com. So if we don't manage to cover the topics you're focused on, please do get in touch that way. The other thing to note is that some of you may already have signed up for this. As part of the masterclass, we offer a one-to-one session with one of our advisors to talk about your financial plans, what you're trying to achieve, build upon the things that you're going to learn today so that you can put it into practice for yourself and see how you might be able to work with Netwealth. And I think shortly there'll be a link to book up for one of those sessions in the chat as well. So what are we going to cover today? Well, I think the first thing to note is that we're going to try and make it simple for you to think through the key elements to building your financial plan, define your financial objectives and priorities, think about your stage of life, your income, your expenses, think about how to account for various factors that can affect your financial outcomes. How can you model for inflation and taxation? Can you use the tools that we've built? So we'll show you some of the things that we've done to help you think about this. It's a regular problem. Everyone's situation is different, but there are lots of ways that you can try and clarify the situation and make it easier for you. And then we'll finish up by explaining how you can do financial planning with Netwealth. I think it's really important to note there is a lot of noise out there in the world right now. We've just had an election in the UK. We're about to have an election in the US, and there's all the things that are going on there with Biden and President Trump and Kamala Harris. We've got some geopolitical risks as well. So I can imagine for lots of you, it's really hard to focus on your more strategic level on your plan and what you're trying to do when all that noise is there around what's happening in markets and what you might want to do. What we find though is if you focus on some of the core elements to financial planning, that actually some of that noise goes away and it becomes easier to make decisions about what you need to do and what you're trying to achieve. That might be thinking about asset allocation. If you look at how you're positioned today, it might become really clear some changes you need to make. And it doesn't always have to be market driven, it might be more aligning with your goals and your objectives. Similarly, thinking about your income, both today and into the future. Getting that picture will help you understand what you might need to do. And we'll talk later about your need to take risk, perhaps the objectives that you have and how you can trade those off against one another and think about how to blend multiple goals through time. For most of you, there'll be some element of retirement planning to do, and that might be about how to be tax efficient, as well as how to use things like pensions as well. That might mean consolidating existing schemes. We work at different places over time. We build up these different elements through time. Bringing them together can help that in terms of putting your plan into place. We like to use cash flow modeling, and you'll see our wealth planner later on that can really help you make more informed decisions about what you can afford. And I know we had some questions about things like whether we can afford to buy a second property or send kids to private schools, particularly with things like VAT now being added to that. Those are really helpful to help you make decisions and the trade-offs, the choice between saving more for your retirement or sending your kids to a private school, or maybe it's helping out the grandkids as well and how to do that. We'll overlay some of the important things to think about from a tax perspective around things like drawdown strategies, how you can be as efficient as possible, and how to consider things like estate planning. So for the next generation, which is another important area. We will acknowledge those challenges that we have out there at the moment around what might happen to tax rates. And what we believe is the most important thing is to start to understand where you're positioned today and what you're trying to achieve. And then you can be well prepared if something does change. So there's definitely a risk right now with the new Labour government that if they don't achieve the growth that they're looking to, the fiscal position is quite tough, and they may be in a position where they have to think about changing taxes. And they've backed themselves into a little bit of a corner over to what taxes they can change. So they might have to look at things like capital gains tax, inheritance tax. But if you aren't prepared with your plans as to what you need for your lifetime, what assets you have today, it'll be very hard to react to those changes when they come about. So it's not about waiting for something to be announced. It's about preparing and being ready to know what you could do either in advance or as soon as that is announced. And that's really the key between starting this process of building a financial plan that we're going to go through today. So I'm now going to hand over to Lily, who's going to start to talk about some of the other bits to consider as we start to build out that financial plan.
Thanks, Matt. So Netwealth's philosophy, really, when it comes to financial planning and investing, is focusing on controlling the controllables, i.e., focus on the things we can control rather than things we cannot to try and achieve the best outcomes. We're going to touch on some of the controllables in a bit more detail later in the webinar. But to start, let's look at the things that we can't control on the left-hand side of the graphic here. So we can't control market performance, inflation, or longevity, so how long we live for. But these can all impact our financial plans. So we can include them in modeling. For example, at Netwealth, we model to age 95 for prudence to control for longevity in our projections, and we also factor in inflation. But we can't control for them more than doing that. Whereas moving to the right-hand side there, we have the things that are in our control. So these include spending time in the market rather than trying to call tops and bottoms, having a well-diversified multi-asset portfolio, tax efficiency, and also minimizing fees where possible. These are things we can control, and they're the key starting blocks for building a financial plan, focusing on those four things on the right-hand side. So how do we get started building our financial plan with the controllables at its core? The first step is to define your financial objectives. Financial objectives are going to change during different points in your life, so review your current position and figure out where you stand today. What's your breakdown of these four boxes? For example, how's your pension invested in light of how far away you are from retirement? Are you holding too much cash? Do you need help investing this in a tax efficient way? Have you paid off your mortgage? If not, what interest rate are you paying? How long for? What's your annual household expenditure? Do you need to account for private school fees or perhaps a home renovation project? So what's the objective? What's important to you here? Perhaps it's paying down your mortgage more or saving more into your pension. But to build your financial plan and figure out your objectives, we start here answering these questions and analysing these four boxes of where you stand today and where you would like to get to. Once we've looked at this, we then look at how much we should be allocating to each pot to meet our goals. So at Netwealth, we like to think everyone, irrespective of the size of your portfolio, big or small, has three pots of money. Starting with pot one, this is your liquidity. So that can be made up of your salary, cash, portfolio dividends. It's largest sources of income that are there to meet your shorter term outgoings. Pot two in the middle is where Netwealth sees itself. So your core multi-asset, well-diversified portfolio with multiple drivers of return across medium to long-term time horizons. And at Netwealth, we believe pot two should be liquid and low cost as well. Finally, pot three. So this is characterized by illiquidity and more volatile. So your riskier pot where you might have single stock equity positions, for example, property would go in here, private equity holdings. So higher risk investments that aim to generate higher returns, but with some more volatility. So everyone will have these three pots in differing amounts. It might be time to rebalance the mix of those pots in light of your financial plan. And that correct mix of these three pots will evolve over time, depending on whether you're younger and at an accumulation stage or retiring and so in a decumulation phase. So start thinking about your financial plan, whether building it or if it's already established, the three pot theory can be a good way of thinking about it. And as I said, the allocation to each of these three pots might need changing or updating in light of your objectives. So how do we account for factors that do affect our financial outcomes, like market volatility and inflation, that, as I mentioned earlier, are out of our control? Firstly, market volatility. So this slide demonstrates nicely the levels of market volatility that can be experienced year to year in markets. So this graph shows that in any given year, markets are volatile, highlighted by that biggest intra-year drawdown in the blue bars there. In other words, how much markets fell at times during the year. So if we look at 1998, for example, the biggest intra-year drawdown in equity markets was over 20%. But what's important to note here and compare the blue bars to is the total calendar year returns in the grey. So looking at 1998 again, there are intra-year losses, so times in 1998, where the equity market was down over 20%, as shown by that dark blue bar. But despite this, the total return on the year as a whole is over 10% positive return, shown in the grey. So markets can be volatile throughout the year, but still end up delivering positive total returns on the calendar year as a whole. Of course, there are times where it doesn't work in this way. So looking at 2008, for example, 2020 as an example, where both the intra-year losses and the annual returns, so both the blue and the grey bar, are negative. But even as recently as 2023, so last year, where we still felt some volatility and times where the market was down throughout the year, overall, the annual returns on the year as a whole were positive. So remaining invested throughout the interim downturns to participate in that upside is important for your financial outcomes. If we're jumping in and out of markets when experiencing volatility throughout the year, you may miss the crucial total calendar year positive returns. So it's important to understand markets can be and will be volatile, but pick a level of risk where you're comfortable riding out that interim volatility to participate in those positive overall year on year returns. Matt will touch a bit later on how to best choose your risk level in the session. But for now, everyone seems to appreciate investing when markets are going up, but even in times of negative markets, investing can be beneficial and remains an important tool in enabling us to meet our financial goals. So on this slide here, we've tried to show this by running a projection of £250,000 invested either as cash or in a Netwealth risk level 4 balanced portfolio. We've chosen 2007 specifically here, as this is what we term a bear market period. A bear market is defined by a prolonged drop in investment prices. So that's why we've chosen this period to show the power of investing versus cash, even in negative markets, where logically a lot of us might think it makes more sense to be cautious and in cash and out of markets altogether. It's worth pointing out in this projection that the cash rates used from 2007 were lower than they are now, so it's worth taking that into account when looking at this projection. But where the new average for cash rates will settle and where inflation is out of our control. Now, if we look at the dark blue line that's holding £250,000 in cash, and the grey is £250,000 in the balanced portfolio, we're essentially comparing investing versus cash and making £18,000 withdrawals from these pots and how this looks over time for the person's financial plan, specifically as I've highlighted in a negative market. So as you can see, around the start of the time of the global financial crisis, on the far left, that grey line and the value of the investment pot has dropped. And so it may have made more sense to be in cash during that period with that initial drop. However, by about 2009 to 2010, despite that initial drop, the invested portfolio has recovered as markets have a good ability to rebound, and that additional value from investing kicks in, shown by the solid blue at the bottom. So much so that as we move over to the right-hand side, you can see that when held in cash, the £250,000 invested in 1 month LIBOR rates with the £18,000 withdrawals actually runs out by December 2022, whereas the balanced Netwealth risk level 4 portfolio still has over £80,000 left by the end of 2023, and so can continue to meet these £18,000 a year withdrawal requirements. The aim of this slide really is to show that despite volatile markets or even negative markets, as shown in this case with the bear market period, investing does make sense to meet long-term goals and withdrawal requirements as opposed to holding in cash. So when building a financial plan for your future, although volatile markets can be intimidating and it can be tempting when things look bad to withdraw from markets, and intuitively we may feel the safer bet is cash, remaining invested even through bear markets improves your financial outcomes as opposed to holding in cash. And holding too much in cash is often a lesser considered risk for financial plans. And a good financial plan will take into consideration the amount needed to be kept in cash without falling into the traps of holding too much cash and letting inflation erode the value of our capital. And this is something we regularly talk through with clients, how much to keep in cash and how to effectively invest the remainder. And this is something that we would be very happy to discuss in the one-to-ones that Matt mentioned. There'll be an email circulated afterwards if you haven't already booked in. But for now, Matt's going to touch on a bit of diversification in portfolios as a controllable that's also important for financial plans.
Great, thanks, Lily. I think it's great to look at a slide like this that Lily had put up and really just start to think about, well, of course, if you were able to switch from cash to investments at the perfect moment in 2009, you'd be even better off. But that is something that we think is extremely hard to do, and that's why we think you should remain invested. But if you're going to remain invested, and in particular if you are drawing down, you might need to start thinking about how to make sure that you're smoothing the path of return as much as possible. And this is where diversification comes in. And it's something that you can control, and you can start to help try to think about having different asset classes providing you with some protection in different market environments. And when we build our portfolios, we're always trying to look for where the diversification can come from. Now, if we're at the lowest end of the risk spectrum, diversification might be of credit risk. So we might be investing in cash-like deposits, but spreading that across lots of different providers. At the highest end of the risk spectrum, we're going to be thinking about diversification across different markets. So don't have everything in the US or everything in the UK. Diversify across companies as well. Don't have all of the exposure to one company. We want lots of different companies so that we get a more general exposure. Now, if you picked the perfect market at the right time or the perfect company at the right time, then yes, you would be better off. But the probability of doing that is very, very low. And so therefore, we think it's much better to get overall market returns and then strategically build in some characteristics that help give protection. And one particular asset class that can provide protection at times of market stress is fixed income or bonds. Those terms are used interchangeably, but essentially this is where you lend money to someone, a government or a company, and in return, they give you a fixed level of income and return over time. And that can be really helpful because at moments of market stress, those assets tend to do quite well. And what this chart shows us here is that we're looking at the biggest intra-year equity drawdown, so the sell-off part, just the negative return for negative years in equity markets, and then what happened at the same time in fixed income returns. Because what we want is an asset class that goes up when the other thing is going down. That's the perfect level of diversification that we can see. And we can see that in most cases, when equity markets were down a lot, the fixed income part was either down a little bit, but a lot less, or in fact was in positive territory as well. And that's what we're looking for. There are other things that we can use. And so when we construct portfolios, we firstly think about the strategic asset allocation. And we're trying to think here what mixture of assets might provide that protection. That might be currencies, for example. So we might add US dollar or Japanese yen into the portfolio because they can provide protection at moments of market stress. And then we'll reassess those over time because those correlations, those diversification characteristics do change through time. And then we'll think about implementing into those portfolios with a diversified index. So we don't pick single stocks and we don't try and pick managers that outperform. We focus on passive indexes that will give us that really diversified exposure to markets through time. And then make adjustments if things do need changing to reflect the fact that there's still some nuance to those different allocations as they change or those indices. But we're generally trying to get market exposure in a very efficient way through time and keep the cost of investing, one of those other controllable elements, as low as possible through time. So we build up these asset class mixes, as you can see here, across our 7 different risk profiles that have a number of different characteristics embedded inside of them. Within those different asset classes, so the different colored bands, will also have diversified investments so that we're not just picking one company or one country or one bond or one equity through time. But it's that range that matters. What you're going to need to understand is where you stand today. What's your current picture? Because these are maybe what you want to allocate through to in time, or a combination of these different risk levels for different goals and different objectives. And we'll talk about how you might think about matching up different time horizons, different levels of risk to different parts of your portfolio and goals. But when we looked back at how to get started, you need to understand where you are in this kind of mix today through time. And what Lily's going to do now is just help you think about that and how ways that you can consider where you're positioned and what your current starting point looks like. What mix of asset classes have you got? It's not always that easy to work out, but we've built some tools to try and make it easier for you to understand.
Thanks, Matt. So we did actually have a question sent in about how you can see all of your different pots in one place without having to make multiple accounts. And in answer to that question, I'm going to spend some time now on the technology we have at Netwealth that you can register and use for free to achieve this. So if you go to www.my.netwealth.com, you can register and use our wealth tracker tool that I have loaded up here. to see all of the accounts that you have across a variety of providers. So if we scroll down here, it will automatically pull through any Netwealth accounts you have if you have them. But you can see this demo account doesn't, but you can add your other providers to see them all in one place. So St James's Place, Barclays here, for example. Now, this is useful for your financial plans because you get a holistic overview of the asset allocation across all of your different account types that might be slightly differing. As the question alluded to, different financial goals, different time horizons. For example, you might have more risk in your pension account relative to the ISAs, as perhaps the pension's earmarked for longer term retirement savings or passing wealth on to the next generation, and the ISA is more for medium term financial plans, and the investment composition of your portfolios might differ to reflect this. So you can see here the split of asset class exposure across all of those different providers and also the value by account type. So here we can see about 60% allocated to equities across the different general investment accounts, ISA accounts, and pension accounts, all with different providers. But quite a significant portion of that is in cash and money markets too, as shown by the pink in that circle there. The majority of assets are in the pension wrapper that we can see here. So we're just getting better oversight of our financial plans, even if we're implementing slightly different plans and strategies with different providers. You don't need to open multiple accounts. You can track all of your existing accounts in one place here. It shows you the value through time, and you can change the time horizon that you're interested in using the toggle there. So this tool is helpful for financial planning because it points out too much cash and pot one, as is the case with this demo account, or perhaps it might point out that you have too much property or a liquid pot three and prompt you to update your financial plan accordingly. It might also give you information that you didn't have access to before. For example, if we delve deeper into the St James's Place account here, we can see a holding simply called St James's Place Balanced Pension Fund. You know the name of it, but you don't particularly know how it's invested and the underlying investment setup. All you need to do is enter the fund name into the wealth tracking tool by clicking Add Holdings here, and it will run the underlying asset allocation analysis for you, telling you exactly up here how much is in equity, fixed income, etc. And it will update the overall asset allocation on the main page accordingly, perhaps pointing out an overexposure that you weren't aware of because you had the name of the fund, but this doesn't necessarily give any underlying information away, such as balanced. Another example we commonly see is in workplace pension funds. So if we go back to the beginning and have a look at this legal and general fund, for example. So this work pension fund, you're enrolled in an employment scheme called diversified fund, and that's all you know. So again, all you have to do is type that in, and we'll then see the analysis of the underlying holdings, and that shows actually this fund is more biased towards lower risk and fixed income and cash like assets that you might not have been aware of by simply knowing the name of the fund or selecting the name of the fund as diversified fund. It doesn't give us that much information, and this investment allocation may not actually be in line with the goals and the time horizons that you had earmarked for your pension. And we know from the information that Matt touched on just now on diversification, the importance of this in our financial plans. And these tools may help to point out these overexposures to you. So at Netwealth, we use technology like this to aid the oversight in our financial plans. It enables us a top-down view across various plans that are in place with various different providers. And this transparency is key for helping to build the solid financial plan and making sure the different pieces, perhaps with different time horizons and goals, are working together for the best outcomes for you. So in this example, pointing out to the client that their second biggest asset allocation exposure is in cash. If we go back to the main page. So how can we better organize their investments so that they still have cash reserves in their plan, but not so much so that it's a risk in meeting their objectives as inflation's eroding the real value of their capital. So do sign up to use these tools and get that improved oversight of your accounts in one place. And of course, we can discuss these further in the one-to-ones. But Matt's now going to talk a little bit more about risk level selection before giving a demo of the Wealth Planner tool, online tool that can work nicely alongside with this Wealth Tracker tool.
Thanks, Lily. So Lily's shown you the ways to start thinking about how you're allocated today, and she highlighted that it might be that in different account types, you've got different exposures. What you need to start to understand is, well, what level of risk, which will drive the type of exposures do you want in different places for different goals? And so how do we think about selecting a risk level? And it needs to come from a combination of different things. You want it to match up with your goals, but it also has to reflect your feelings about risk and how you are comfortable with it and what your wider financial circumstances are. So when we think about how much risk to take, I need to think about your ability to take risks. So this is going to be driven by your overall financial circumstances. If you don't have any income right now and you're living off your investments and you need to draw a relatively large proportion of your investments down each year, you might not have the ability to take much risk with those. If you have income coming in and you're making savings every year and you don't plan to draw anything for 10 or 15 years, then you might actually be in a position where you can take more risk as well. And that comes down to time horizon, which we'll touch on in a little bit more detail. But what we want to be thinking about from an ability to take risk is to make sure that you're never a forced seller at the wrong moment. So that if you are going to have to sell down your investments and draw from them, you want to be invested in something that isn't too volatile and won't have had too many drawdowns. Whereas if you've got more time, you can afford to ride out those ups and downs, and in return, you should get more return that comes back to you over time. The other part is willingness, because if ability stops you from being a forced seller, what we want to do is also make sure you're not an unhappy seller. The worst outcome that can happen is that you're invested in something, the markets have a negative period and the portfolio moves as you might expect for that level of risk, but you're uncomfortable with it, and what you do is you sell out at the bottom. And we see this happen. Let's take, say, the financial crash or the COVID sell-off, and it can feel really bad at the lowest part. The news flows really bad. Everyone's talking about different things, and it sounds like it's never going to get better. You sell out of it, and then you wait for it to sound better. But by that point, markets have recovered, because markets are always looking a few steps ahead. What ends up happening is that you sold out and you buy back at higher levels. And so that's because you were uncomfortable. So we need to find a level of potential losses that you can tolerate and feel comfortable in accepting. No one wants to see a loss, but some people will be more comfortable with seeing the kind of losses on that chart of the right-hand side at risk level 7 and accepting that it might fluctuate down 31 year, because they're happy to strive for the plus 46s, and others will never want to see their portfolio fall more than 10%, and then you might be needing to look at the lower end of the risk spectrum. The final thing to consider is your need to take risk, and this is really coming back to cash as well. So if you have enough funds that you don't need to worry about inflation and you don't need high returns, then great, you can afford to be in cash, you don't need to take any risk, and you can just have that money and that'll be okay. But for most of us, we need to take some risk to get some return, to keep up with inflation, to grow our pots over time so that we don't have to save quite so much towards our goals. So it's balancing that ability to take risk, that willingness, and that need through time. Just to think more about time horizons and how you can break down your portfolios into separate goals that might have different time horizons, and why you might match them up with different risk levels, I want to look at this particular slide, which was focusing on the percentage of times you would have lost money in the last 25 years over different time horizons with different risk levels. And this is where we might be thinking about, say, a pension that might be a long-term goal for some of you, that you might potentially put at a higher risk level, versus something that you might need next month or next year where you need to put it at a lower risk level. So if I start on the left-hand side and look at the 1 month time horizon over a rolling 1 month period over the last 25 years, there's a relatively good chance that you'll have a positive outcome in any one of those different risk portfolios. In that, if we look at, there's been a negative outcome less than 40% of the time at risk level 7, which is the bright blue bar, risk level 4, which is the grey bar, or risk level 2, which is that greeny turquoise color. But those numbers of losses are still quite high. So 35% of the time, even at risk level 2, you could have a loss over a 1 month time period. If we increase that out to 6 months, that loss at risk level 2 drops down to 20%. And if I go up to 1 year, it drops to 15%. If I go up to 5 years, there haven't been any periods on a rolling 5-year period that you've made a loss at risk level 2. The same is actually true for risk level 4. And if we get out to risk level 10, then actually you haven't seen a loss at risk level 2, 4, or 7. But that's a 10-year time period now. So you need to make sure you can afford to take that time period. But that starts to help you think about how to separate out your different goals, your different time horizons to different risk pots and perhaps blend them through time. It doesn't all have to be amalgamated in one. You can clearly delineate and separate them. And it might be, if you've only got a 1 month time horizon, that you need to be in cash because that won't fluctuate at all. And that's the right place to be. But as you start to have longer time horizons for parts of your goals, you can start to take a little bit more risk as well. Now, what I'm going to do is help you think about how you can use our tools to consider those goals and how you might be able to achieve your different outcomes that you're looking for. Because this is really how we start to bring the plan together. So far, we've been talking about where you are today, what you're trying to achieve. Now we want to think about how that all fits together into an overall position as well through time. So what I'm going to do is I'm going to go and look at those tools that we talked about, and bear with me 2 seconds. I'm going to log into an account here. So I'm going to go to that my.netwealth that we talked about. I'm going to log into one of those demo accounts as well. And we're going to come back to the same position that Lily was looking at from that client with a wealth tracker. But this time we're going to click on the wealth planner. And in here, we can start to put in our different goals and objectives that we have. And we can start to see how we might be able to achieve those through time. So this person is 44 today, is planning to retire at 69. They want a net income of £4,000 a month, and they've got a plan for a one-off withdrawal. And in fact, actually, we had a question that came in that kind of thinks about this. It was someone saying, how do I think about the trade-off of buying a second property today versus saving towards my retirement? And this is what the tool is designed to help you do. It might be that this one-off withdrawal is for to put it down as a deposit for a second property. That means that they're going to have less money than they had before to go towards their other goals. And for this person, as we track forward, they take out that money for the mortgage on the other property, and then they start to go towards retirement and they start to draw down. But the money's going to run out when they're age 88. Now, we talked about things that you can't control. If you remember Lily saying we always model to 95, because although average life expectancy for someone who's 44 probably is around 88, the risk is that you live longer and that you run out of money. So it might be for this person that they need to think about changing that goal. So it might be that they take out that idea of the one-off withdrawal, they delete that, and they go back and rerun their projection and see what the outcome looks like. So now they're not going to have that 100,000 paid out. Instead, they're going to just be saving towards their retirement goal of the £4,000, and we start to see what that picture looks like. Now that's starting to look a lot rosier. The money's actually going to last to age 95, and there's going to be some money left at the end. In this scenario, on average, there's 400,000 remaining, and in fact, if markets are stronger, and you can see these things are quite sensitive, there's nearly £2 million remaining. So it makes a big difference, and you're going to need to keep looking at it and adjusting it through time. You can look, though, at the individual different parts of your plan, get some more details on it. You can go down into the individual parts of it as well. So that let's, for example, take the pension, and you can select different levels of risk. So at Netwealth, we have risk levels 1 to 7, but we add in risk levels 8 and 9 because we acknowledge that if you're managing the money yourself, you could, for example, have 10 single stocks, and that might be more like a risk level 9 than a risk level 8 because it's not so diversified, and it should hopefully give you more growth through time. You can also look at things like defined benefit pensions if you have those and add those in, your state pension as well, and be able to add that in as well. So we can factor all of that income in. And we're always targeting a net of tax income and thinking about inflating that as well through time. So we always use an inflation rate at the moment now, long-term average of 2.3%, which is just acknowledging that we don't think the Bank of England will keep it exactly at their target rate, but we've probably gone beyond those higher interest rate, higher and inflation rate numbers than we had in the last few years. We're perhaps through the other side of that. You can also adjust the level of contributions you're making. So in this instance, someone selected this as a cash ISA. We could change that to risk level 7 and say, I'm going to strive for growth. And then we can look at the contributions that they're making into it as well. So they're saying annually 15,000. Let's say annually they're going to use their full allowance and they're going to save 20,000. And then you can say when you want those to stop savings to carry on until through time. You could go back to your general investment account and say, right, well, in this instance, I'm going to have this one as my cash saving. This is going to be my rainy day fund. That's my set where I'm going to keep my 15,000, and I'm going to keep that as a something to hold on to. Generally, we say when you're working, you should keep around 3 months of your net income as cash, and as you move towards retirement, you might want to go closer to a year. Now you can start to see that those adjustments have really made the plan look a lot more achievable through time. And it might be that as we loop back round, they can go back to that plan of buying the second property and adding in a one-off withdrawal. So let's do that now, and we can put it in second home. Plan is for I'm going to put 100,000 towards that, and I want to do that in June 2030. So I'm going to put that goal towards other property. Save, and then I'm going to rerun my projection. And hopefully what you can see here is it's the iterations through that can help you make more informed decisions. It's really important to note that this is the framework that we use when we work with you through an advice process, or even just in a guidance chat like the sessions that you can book in. You can start to see how achievable that might be through time and the impact it has as well as we go through. You need to check your inputs and make sure they make sense. I think it's important to make sure we haven't done anything inaccurate there when we play through the different parts, and make sure that all adds up and it's sensible. What are we doing? When are we going to be making those savings? But if you do that, then you should have a sensible plan through time. So I might adjust this back down again, and I'm actually going to say I'm going to do it monthly. I'm going to do £1,000 a month, and make that adjustment again, go back round through the loop and see what that does to my plan through time, and the impact of that by just taking more risk in the ISA, for example, where I was saving regularly instead of that being in cash. It's made a big difference. So I don't necessarily need to make those savings as much savings, but that's really how you can see those trade-offs. So you might not you're taking a little bit more risk there. That's the choice, but in return, you've been able to put 100,000 towards that second home, and that's really the trade-off to consider. So that's how the wealth planning tool works. I would encourage you to take a look at it. And as I say, if you do book in one of those sessions, we can take you through looking at that together, and how that might work for you individually, because everyone's goals will be different. Everyone's trade-offs will be different, and how you value them will be different as well through time, and how you think about that. So at this point, though, what I'm going to be doing is just handing over to Lily, who's going to look a little bit more at tax efficiency, and how to think about that as well when you're building out your plan.
Brilliant. Thanks, Matt.
Perhaps while Lily's getting that up, I'll just remind everyone that you can put in your questions. We had some that came through at the beginning, which we're trying to cover as we go through, but do please send through as many questions as you have, and we'll try and cover them either as we go through or at the end of the session.
So as Matt mentioned, tax efficiency is what we're moving on to next. And as I mentioned at the start, tax efficiency is one of those controllables that we're able to account for. And it's important in financial plans, and it can help give you the best chance of meeting those objectives. So here I've listed out the different tax wrappers and tax planning considerations for building a solid financial plan, starting first with pension contributions. So maximising pension contributions makes sense due to the tax relief government top up you get on the way in, and also the fact that the investments grow free of tax when inside the wrapper. But they can particularly make sense for financial plans if you're impacted by the additional rate tax threshold. So if this is applicable in your situation, it's worth checking how much annual allowance you have, how much carry forward, unused prior allowances you have as well, as an increased pension contribution may make sense to take you back under that additional rate threshold and beneficially impact your financial plan. We help clients with this a lot at Netwealth, doing all the sometimes seemingly complicated calculations of tapered income and carry forward for you, and telling you how much you can put into a pension contribution and analysing whether that additional contribution indeed makes sense. That's an advice package that we offer for £400. Matt will touch a little bit later on financial planning and Netwealth, but if you would like to find out more, then please do email advice@netwealth.com. Allowances. So utilizing family ISA allowances remains one of the best ways to shelter assets from tax. So making sure you're using these on an ongoing basis and updating your plan to reflect the potential increase that we might see with the introduction of a new British ISA, maybe increasing that allowance by another £5,000. This, of course, was announced by Jeremy Hunt in the previous government, so we await more details on whether Keir Starmer's new government will indeed continue with that or not. Moving on to capital gains tax allowances. So these have been continuously cut and now stand at £3,000. So ensuring we're using that allowance, even if it feels smaller compared to historically, on an ongoing basis if you have assets that can be rebased at higher book costs. So capital gains tax harvesting as well is a service that we offer at Netwealth and no extra cost to clients, just to ensure that they're being as tax efficient as possible on an ongoing basis. And again, this can be discussed in more details and practicalities of how it might relate to your specific situation in the one-to-ones. It might be particularly topical on CGT if Labour announce any plans to change CGT rates. So that could be a good starting point for discussions in the one-to-ones. Finally, tax efficiency. Finally, on tax efficiency, inheritance tax. So the threshold has been frozen, moving more assets into your estate in what we call a stealth tax. So thinking about gifting here and some financial planning around it could really make sense. The rules of any of these points on this slide on tax and allowances could change with the new Labour government. But another key to building a solid financial plan is making that plan with the information you have based on current rules and then updating them accordingly as necessary. And our advisors at Netwealth are always happy to sound check financial plans in light of any legislation changes as and when they occur, and of course put on webinars such as this in response to big changes and events like an upcoming budget. Now I wanted to take some time just to talk through this case study showing the importance of tax wrappers in practice to maximise financial plans with simple things such as the way we access our funds. So the Wealth Tracker and the Wealth Planner that me and Matt have demoed today are great tools to enhance our financial planning, but sophisticated cash flow modelling and the benefits of taking formal advice on our financial plans with something as simple as drawdown strategy and the benefits of this will hopefully be shown by talking through this example. So we have Annabelle, she's 65, she's just retired. She has a pension of £1 million, which she's crystallised in full. She's taken her tax-free cash and she's put it into drawdown. And that £250,000 tax-free cash is then reinvested into a general investment account. And then every year she's going to be tax efficient and just move those funds from the general investment account to the ISA, making the most of that £20,000 ISA allowance. She's invested in a balanced 60-40 risk level 5 net wealth portfolio, and she's looking to take £3,500 net income a month from her investments. Her main objectives are providing, of course, for her own income throughout retirement, but she'd also like to pass some wealth on to her 3 children. So in this first scenario, we've modelled for Annabelle taking her £3,500 from her pension account until this is depleted, and then she's going to draw from her remaining investments in the general investment account, the GIA, or the ISA. As you can see from this modelling, this is a good outcome for Annabelle. She's comfortably able to meet her own income needs until age 95, and she actually has £330,000 remaining in her ISA, assuming the average scenario returns. So she's met her objective of providing for her own income needs throughout retirement, and there is some left in the ISA to split between her 3 children after inheritance tax. So passing wealth on has also been achieved. But could this have been more efficient? So if we look here, we've got the exact same inputs. The only difference with this scenario is Annabelle has been thoughtful with her drawdown strategy from a tax perspective, perhaps taking some one-off formal financial advice around an optimal drawdown strategy. And as you can see, the outcome is better. So by drawing on a blended basis and taking £3,500 from the pension, general investment account and ISA simultaneously, utilising her full basic rate band each year, she has £655,000 remaining at age 95 instead of £330,000. So firstly, that's important for Annabelle's objective of providing for her own retirement, because now she may be able to draw more than she initially thought. She might be able to take £4,000 net income per month instead of £3,500. But this financial advice has also helped her other objective of passing remaining funds onto her 3 children. As importantly, the remaining funds now on her death are in her pension rather than her ISA in the first scenario. And as things stand, pensions are outside our estate for inheritance tax purposes, and so an efficient vehicle for passing on wealth. So with some financial advice, Annabelle has bettered her own outcomes and may be able to draw more income if she desired, but she's also bettered the outcomes for her 3 children as they'll have more funds from her passing from her to them that they don't have to pay inheritance tax on. Obviously, again, if Labour change anything around inheritance tax, it makes sense to check on your financial plans with an advisor and update the plan accordingly if needed. Financial plans are constantly evolving throughout our lives, depending on our age, expenditure, objectives. But legislation changes with new governments can also impact financial plans, and these need to be responded to as appropriate. So, a thoughtful strategy, taking formal advice might be appropriate. A drawdown strategy in retirement planning or gifting assets away for inheritance tax purposes if the rules around pensions are changed, are popular pieces of advice work that our advisors deal with and model for. So now I'm going to pass back over to Matt, who's going to touch on a bit more about how Netwealth can help formally on the advice side to help build that financial plan.
Great, thanks, Lily. Yeah, absolutely. So I think when we're thinking about financial planning, Lily's given some good examples of how you need to be thinking about your starting point, understanding where you are, looking through what your goals and objectives are, and looking at the trade-offs and decisions that you can make, and then getting some specific advice on how to implement that in a really efficient way. That going through that process can also help you think about other things that maybe weren't a primary goal, but you can afford to do. So if you know the level of income you want and you look at your drawdown strategy, and you can maybe have the confidence to pass more money on sooner rather than later. And then if you know that today, you might be ready to preempt something if there's a change, for example, to the rules around inheritance tax. One suggested avenue that a new government might take is to switch inheritance tax from being charged on the estate upon death, but actually charge it on gifts at the point of the gift being given. Now, we don't know if this will or won't happen, but it's good to know in advance how much you might be able to give. So then if the rules change, you're going to have some time to be able to get on and make that change, that gift, rather than having to rush through working out whether you can afford to do it and make the decision whether to do it or not all in one go. And so we do think taking a little moment to preempt what could happen, understand what it might mean for you, is well worth doing, whatever stage of your plans you're at as you go through. So let's think about how financial planning at Netwealth is available. We do have access to advisors. So if you're an investment client, you can get guidance from advisors at any point. This is where we can give you facts and information. We can chat through some of the things to be thinking about. We can look at those tools with you. But if you want a more structured option to really work through the ins and outs, to get more specific personal recommendations and to work with an advisor on an ongoing basis, then you can use one of our advice options and planning reports. We offer that both on a one-off basis, where we'll work out a scope of work for you, understand what it is you're interested in thinking about. It might be an initial retirement plan, it might be specifically around a drawdown strategy, or potentially around how to make a pension contribution and the amount you can do to maximize that through time. And we'll do that on a one-off basis, and we charge for that on an hourly amount based on the level of work that we do. The other alternative is a more proactive, ongoing service, which is our ongoing advice service. For those clients that are investing with us, you can opt to add on ongoing advice, where we'll work with you regularly to craft your plan over time, to adjust it. We'll proactively reach out to you, and you'll have a dedicated advisor that you speak with twice a year to be able to adjust your plans and think through time. So for some clients, that's really important. Other clients, they might start with no advice and then add on one-off advice, and then perhaps convert to ongoing when they get closer to retirement. You can pick and choose, and we think it's really important that you're not paying for a service that you don't need, but that you do have access to it when you need it, and you're always going to get comprehensive information delivered to you for you to think about through time. So just to go into a little bit more detail on how those fees work for those different parts, if you're taking the one-off advice, as I say, we'll think about the scope of work, and we'll provide you with an estimate of the number of hours, and we charge £200 per hour, including VAT, for that advice work. So you'll know in advance what you're signing up for and what you're going to get back in return. Then for the ongoing advice service, this is charged at 0.35% per annum of the value of assets invested with Netwealth. And that's the more proactive, regular service that has a dedicated advisor that you'll work with through time. And so that might be a more appropriate thing for you if you're going to have more complexity, more needs, or you want that additional hand holding and support as you go through your financial plans. We do also have some packages that are there for people that want more ad hoc support from time to time. So that might be things like pension contributions that Lily touched upon, doing those calculations on how much can I afford to put in, what's the tax efficient option to do for that, how do I maximize getting tax relief in different tax years. And then we have our drawdown package as well, which is, I think, really helpful if you're going into that specific moment when you're about to start drawing on your pension, deciding whether you should crystallize all of it, some of it, the routes for doing that through time as well, which can be a really helpful way to start thinking about that next stage on your financial plans. The other service that we have is a structured guidance service. So I mentioned that you can speak with our advisors and get guidance, factual information, but you can also have a more structured report that's put together where we start with those modeling tools that you saw. So you enter your details in the tracker and we look at the planner, and we can either do that on an individual or a joint basis. You have a structured session with an advisor for half an hour, and then we go and deliver you a report that talks about how that plan fits together, the changes that might need to be made, and how to take the next steps through that as well. And so for a lot of people, this might be what they need to get started. And really what we're trying to do is give you the different options of how you work with us, depending on the level of complexity you have, the level of confidence you have in the situation yourself, and how you might want to work with us through time. But we're always going to use that same framework of understanding your current position, thinking about your goals, looking at the trade-offs, putting in place a plan that controls the controllables and thinks about modeling for those uncontrollable elements through time as well. If you're interested in any of those services, please do just get in touch through advice@netwealth.com. What I thought we'd do now is I'm going to give you all a moment to put in any questions you might have. I know we've had some that have already come in, which we'll cover on in a moment, but perhaps before we do that, I'm just going to go through this summary here briefly to think about some of the things we've looked at. So what have we covered today? Well, firstly, thinking about your financial objectives and priorities and that they might evolve through time. You want to be thinking about your mix of the different pots you have at different stages of life, how much you have in cash, low risk, how much you have tied up in illiquid things like properties as well, and how much you're putting in those more illiquid sleep well type pots as well for the longer term goals. Always control the controllables to give yourself the best chance of meeting your goals. Think about time in the market. Don't try and time it too much. It's very difficult to do. Be as diversified once you've picked your risk level. Make sure you have a diversified mix of assets through time. Minimize fees wherever possible. It's one of the things you can control, and it makes a big difference to achieving your goals. And then be thoughtful about your withdrawal strategies, using your tax allowances. Get some help and advice if you need it in order to do that through time. But being efficient there again is something that you can definitely control, and it doesn't matter what happens with markets. You'll be better off if you get that right. You can use our tools to help you think about your financial plans and track your wealth and use the planner as well. That can be a great starting point just to get you thinking about what's an option, what's available, and you can access those at my.netwealth.com. I think there's a link in the chat as well for you. If you want to work with us, please do get in touch about advice. But as well as a first step, which is completely complimentary, you can book your one-to-one session to talk through some of the things that you're considering and you want to think about. We can put that in the context of those wealth planner and wealth tracking tools so that you can get a sense for how things work and what might be the right things for you to be thinking about on a more personal level. A lot of what we've covered today is generic. Hopefully there's been some key areas that answer some of the questions you've got, but we'll be very happy to answer more specific questions on those one-to-one sessions. So please do put one of those in if you haven't done so already. I can see Lily is back on now as well. And so what we should probably do is touch on some of the questions that we've had that have come in. Lily, are there any in particular that you'd like to draw out to get us started?
Yep. So there was an interesting one that came in around sort of financial planning. How do you handle inheritance tax planning and recording previous lifetime gifts?
Absolutely. So the first stage on that is to make sure that you have enough for your own lifetime. So inheritance tax planning is something that is normally done sensibly in chunks, little bits over time. You build up. I don't know anyone that has worked it all out, done it all in one big bang and just got it right, because you've got to feel comfortable about the trade-off between tax efficiency. Normally that's a gift and getting on with doing it soon, and control, how you feel about handing that money over, whether you want to add in more control and therefore probably more complexity and make it slightly less tax efficient. But you need to understand where you are today before you make some of those choices. There are some great ways to do that we can help you with. So it might be for grandchildren, you set up things like simple bare trusts. And those can be a really efficient way to pass money on, to start that gifting process. But again, you need to know where you stand today to have the confidence to do that. Because generally, a gift that happens sooner is more impactful and it's more likely to deal with the inheritance tax point as well.
Thanks, Matt. That's very clear. Another one that we had in was how to deal with aspects around stopping work and decisions about what to do with pensions if you don't necessarily need to draw on them. So sort of twofold there.
Okay. Do you want to take that one, Lily?
Yeah, sure. So dealing with aspects around stopping work and making those decisions, if you're not as comfortable in the decision and making that decision, then that's where it can make sense to take a piece of advice, whether it be using the financial planning tools to look at the income stopping now or taking a formal piece of advice to give you that extra bit of clarity in your decisions and making you feel comfortable that actually the overall assets you have can help you meet that goal of stopping work. And we can do that in some of the projections that I showed with the cash flow modeling and how to best structure can all be factored into work like that. So if that is something that you're interested in, either on a one-off basis or turning on some sort of ongoing advice as well, then do definitely get in touch. The second aspect of what to do with your defined contribution pension, if you don't need to draw from it, depending on, of course, your attitude to risk, your willingness to take risk, you've got the time horizon there to just grow it as much as possible for the next generation. There's a couple of ifs and buts in there, obviously, that we've mentioned about what a new Labour government might do to pensions and bringing them inside the estate for inheritance tax purposes. But as we sort of touched on, you've got to focus on what the rules are now, make your plans in light of that. If it comes to effect that you might need some more structured planning around gifting assets away, we can add that into some cash flow modeling as well. So looking at how much you can afford to be gifting, whilst, as Matt said, it's sort of in answer to the previous question, keeping in line with your own objectives and providing for yourself first.
Absolutely, and we can help you think about some of the nuanced little things as well. Your expression of wish on that pension. Do you want to add children into that, grandchildren, so that you have some flexibility for how that's passed on in the future? There's lots of little things to think about. The main thing to start off is the big picture. Get the big picture right, and then over time. And this is why it generally needs to be a regular process that you come back and do little and often. You check and you make more adjustments and you make sure the plan still works and it makes sense and you think through those different parts. So definitely keep all those things in mind. One of the other questions we've had here is what are the typical key financial priorities for someone in their late 30s? And I think this is a really interesting question right now because what we're finding for those people is they're trying to work out how to deal with needs today versus needs for the future. So it might be you've got a mortgage and your interest rate's just gone up because you've rolled off a fixed deal, but you're trying to save for your retirement and you're also trying to think about saving for other goals and expenditure today. And how do you find that trade-off? What's the right number to be saving? What's the most tax efficient thing to do? Is there any nuances? Are you at the point where you're earning just over 100,000 and actually you start to lose your personal allowance? So a pension contribution would be really tax efficient. Those are the choices and trade-offs that we tend to find people working through. How do I understand how to balance between putting some money that's just for a rainy day in my ISA, saving for my pension, my retirement, and paying off my mortgage? And it's not there's no perfect answer. It's probably a blend of them, but it comes down to your goals, how you think about it, and how to measure those things together, and in your personal circumstances. Which is why it's always worth having a conversation with someone just to help tease these things out, so that you can understand and you're not missing any opportunities as well through time. Great. Was there any other questions, Lily, or shall we come to a close there?
I think that's probably all that we've got time to cover in the hour session today.
Great. Well, thank you so much, everyone, for joining us today. It's really great to have you on board. Please do get in touch, as we mentioned, through advice@netwealth.com or book in one of those one-on-one sessions if you'd like to as well. Thank you for joining us. I hope it was very helpful to think about some of the key ways to building your stable financial plan. And we look forward to working with you in due course.